from there. So again, we talked earlier about the market update and things along that nature. We went over that and where the market's at. Now we're going to dive truly deep into what are the different avenues for us that we're employing to get our offers accepted, and what are the factors that we're doing that are allowing us the ability to truly get our offers accepted. All right. And there's really no rhyme or rhythm, guys, that I can tell you. All I can confidently tell you guys is we are setting the proper expectations with our clients and making sure they're properly fed with the information that they need to in an effort to make sure that they're being successful. Okay. So the factors that are affecting one's interest rates, the first thing as a consumer is your down payment. Now, this has kind of shifted over the last 6 months with the Fannie Mae, who sets the rules and records for banks. Sometimes the more down payment you put down, like a consumer who puts 20% down, actually may potentially have a higher interest rate than somebody who actually puts 15% down. I actually have a topic we're going to talk about today going into that once I finish this slide. Okay. Then we're going to go over in terms of your credit score. Of course, most of us know the better your credit score is, the more of ability you are going to have to get the best possible interest rate. Very, very simple as that. You know, the media misconstrued it where it's like, oh, well, if I botch my credit score, it is loan to value driven in terms of your risk factor as a consumer. It is not based off of your credit score. You should always strive to have 100% the best possible credit score that you can from an interest rate perspective and truly just from a financial standpoint. And then we start seeing your debt to income. This at one point was going to be a major factor. It doesn't affect your interest rates. It affects your mortgage insurance rates, which is why I still keep it here. The higher your debt to income does have an impact to your mortgage insurance rates. Okay. And then you have your loan type: FHA, conventional, VA, USDA. An FHA loan will always have a more competitive interest rate than your conventional. That's how it's explained. That's how it's done. That is truly the way that things are set in perspective when it comes to those items. Okay. Now, a conventional loan sometimes have, again, a higher interest rate. FHA, VA, and USDA will always have a more competitive interest rate. And that is mainly because there's a backing by a federal agency, whether it's HUD for the Department of Housing and Urban Development for FHA, whether it's VA, the Veterans Affairs, when they're backing that up, or whether it's the Department of Agriculture with a USDA loan. Okay. So that's the consumer's risk factors. Now we're going to dive into what are outside market factors. And this has been the part that is why we're seeing interest rates in the mid to high sevens now. It is these outside market factors. It is your mortgage-backed securities. It is your treasury yields and inflation. It is your unemployment. It is also now our new construction and permits, right? So we've been seeing a lot of pickup in terms of we're starting to see builder sentiment for so long. We're starting to go up. When it was at one point really low, then I believe it was this week, Tuesday, was the first time builder sentiment diminished, which we kind of expected, right? Because nobody knows what's going to be the Federal Reserve stance next month, okay? There's too many different data lags, right? Where a lot of us are assuming that the Federal Reserve is going to hike again, maybe be the last one, or some of us are thinking that the Fed is done. They're no longer going to be hiking. So that is causing a little bit of turmoil within the builder sentiment, right? For them to consistently be able to constantly keep their interest rates flat or hiking. Then we have your home type. So when you're purchasing a home, this is something that is very important for you to consider. When you are purchasing a home, you want to make sure that you have an understanding that the home type that you're buying does have a risk factor involved, okay? So the home type that you're purchasing, if you're buying a single family home, that is the least riskiest type of home. If you're buying a condo or a multifamily home, those have additional risk factors on top, especially condos, right? There's so many times right now when I go through an offer with a client and I tell them, is it a single family home, townhome, or is it a condo? Because if it's a condo, there's going to be, from what I see within our pricing, is a 0.75 interest rate risk factor towards the client, meaning that cost to acquire the cost of acquisition is going to be higher by that 0.75 when it's a condo, okay, as opposed to a single family townhome. Then we have your occupancy. If you're buying the home as an owner-occupied home, those are the rates that you generally are seeing online. Those are the rates that are advertised. You know, your 6.75, your 7% interest rate, that raw flat rate. When you're buying a investment property, those are always going to be higher because there's a higher risk involved with them. Okay. Now, going back to one point that I had, and I wanted to talk to you guys, let me move this here, was the truth about paying more on rates, as we were just discussing. And the one thing I wanted to explain to us, and I mentioned this in passing, was the loan level price adjustments, which is also called LLPAs. Loan level price adjustments, again, they're made by Fannie Mae and Freddie Mac. They were just implemented, as I mentioned, about 3 or 4 months ago with the new changes. So the loan level price adjustments, I'm going to read this verbatim, is based on loan features, such as credit score and loan to value. While the changes do improve costs for lower credit scores, they don't result in a lower fee for those borrowers, okay? So before, when you had a lower credit score, you paid more. That does not mean that if you have a lower credit score, you're going to get a better, less risk interest rate than somebody who has a higher. That's not true. That's, again, what a lot of people misconstrued and started that rumor, so to say. The changes decrease the gap between what lower and higher credit score borrowers were paying, which was larger before the changes. So before, if you had a lower credit score, you were essentially getting penalized, right? Not a bad thing. Dude, I worked hard to keep my credit score good. Therefore, I should be rewarded, right, by not paying more. But again, of course, the media and like every left or right wing person is going to take their own opinions too, right? So that eventually changed. Now, the details. So as I always say, so what the heck are LLPAs? So instead of me boring you guys with it, again, LLPAs are fees and adjustments that lenders, specifically Fannie Mae and Freddie Mac, add to a consumer's interest rate based on the cost of acquisition. And that's a big one because if a client is putting 20% down or 15% down, many instances I always discuss with them and I say, hey, dude, it might be better off for you to put a little bit less money down because it's going to give you guys that ability to get a potentially better interest rate. And if you're worried about mortgage insurance from a qualification perspective, dude, it's like 30, 40 bucks a month. Or, Mr. Client, if you're worried about something else, we're able to simultaneously look at specifically what it is if you want to prepay it up front one time and you never have to worry about it again, okay? Now, another thing, and this is where I want to show you guys, these are the changes that occur, and I'll zoom in. So you will actually see if you're a borrower, let's say with a picture-perfect credit score, right, and you're looking to put 5% down, the risk factor that you will get hit with is only 0.125%, as opposed to if you're a borrower who wants to put 20% down, you will actually get hit with a 0.375%. Does that make sense? Super, super important for us to realize that. So if you're putting, back this up one time. If you have a picture perfect credit score, 0.125%, putting 5% down, that's what you're getting hit with. If you're putting 20% down, it's 0.375. That's a pretty decent difference. That is a 0.25% difference from what you would be able to simultaneously qualify for, okay? Now, look at the difference, guys. When I tell my clients, you got to be able to make sure when you're buying a house, you're in the best possible position interest rate-wise, credit score-wise. Take a look at this same borrower. If he's got a 700 credit score, right? 700 to 720, putting 5% down. 0.875. Dude, that's a difference of basically 0.725. That's a big 0.7.5. That's a big difference. Same exact thing when you go here. If you're putting 20% down, your credit score is lighter, you're getting hit with a 1.5% over a 0.375. Dude, that's over a point and a quarter. So again, the importance of making sure you're in the best possible position when it comes to your credit is just crucial when you're purchasing a home, specifically for these type of situations. So you'll see, take an example, a client with a 700 credit score, put it 750 credit score, right? He's putting 5% down, right? He's at that 0.25%. If somebody who's putting 20% down for that same credit score, he's at a 0.625%. So again, just super important for us to get that understanding and make sure we see the differences where it's not always about how much the most you can put down, because that may actually be hurting you. Okay. So if you're out there and you have 5% down saved, or even 3.5% down saved, like here, your monthly payment is going to be higher. Nobody's arguing with that, but you're going to be getting a better interest rate, which is again going to yield to potentially paying a little bit less, right, than what you normally would have if you didn't necessarily have that access to that cash flow. Okay. So I hope that explains that, because that is just super important for us to remember when it comes to the factors that affect our interest rates, because there's just too many misconceptions that's out there, so many myths. And I am constantly, trying to explain to clients otherwise from what they hear, right? Whether it's reading on the media or seeing the things on the news, it is not always about, what you see on the internet, many instances can be misconstrued numerous times. Okay. So nothing is different than that when we're going over these steps of process. Okay. Now, one thing I wanted to share with you guys, and I shared this before, I have launched an application that gives all of our clients access to pulling their credit report, monitoring their credit, tracking their budget, linking their bank accounts, linking their auto loans, linking their investment accounts. It is all encrypted with the top-notch bank level security. And you get to monitor all this stuff with creation of budgets, goals, and plans. It's 100% free. You're able to track your progress. So if you're looking to buy an investment property, perfect application for you to download. If you guys just go to Paramount Data Vault in the App Store, literally search it like you would download any other app, download the app, and in the code, type in Got Mortgages 1, but it's MTGS. So Got MTGS 1. That is going to give you guys the ability to download that app and have 100% access to pulling your credit. It is not a hard inquiry. It's a soft inquiry. Okay. And it will give you the ability to draw your own budget. If you own a home, it will allow you the ability to track the value of your property as well. Again, for free, and tell you what are the different recommendations. And in addition, you guys all know how I love education. You're going to receive over 140 plus, if not more, plus access to my YouTube channel with a little over 400 videos, right? Access to videos that talk about homeownership, credit, borrowing, and mortgages. Okay. So if you have not downloaded that app, please go and do so. Paramount Data Vault. Again, it's free, costs you nothing, doesn't affect your credit score. There's just way too much value for you to be able to walk away. Okay. And the code again is Got MTGS1, Got Mortgages 1, and I'll give you guys the ability to download that. Okay. So before I dive into this topic in terms of appraisals or anything like that, want to kind of go into the topic of what we're going to discuss with the importance of owning a home. So, over our lifetime, I've had the blessings of being a part of 2 home purchases, building that keystone wealth, seeing that financial influence, seeing, the different avenues of areas. I used to live in Newark previously. I was there about, I would say, less than 2 months ago. And I was able to see the change of the environment, the change of the area from when I used to when I used to live in Newark almost 10 years ago, right? When we were there at Rutgers. So, 10 years ago, geez. So, a quote I wanted to share with us is, think about this. Owning a home is a keystone of wealth, both financial affluence and emotional security. Literally. Those of us right now who are struggling through acquiring home ownerships or whatever it is, you literally have the ability to tap equity within your home to pay off your credit card debt. And I'm doing that for a lot of clients. I'm doing a lot of cash out refinances and a lot of refinances for clients who necessarily are unfortunately going through a divorce and they want to buy their partner out. You have the ability to truly do that when you own real estate. When you're renting, I mean, you don't really have anything to an extent. I hate to say it, but you don't. Or maybe it's cheaper for you. Who knows? But the emotional security at the same time. Right now, a lot of clients that I'll work with, in many instances, they're motivated to buy, but they also kind of sort of have no choice because their seller is putting the house on the market. And that's crazy. If you have kids in school systems and things like that, and you want to pull them out, that is that emotional security. That is truly hurtful. Okay. And it's just so important for us, myself and a lot of my partners, that we stress the importance of that financial security when you're buying a house. Okay. It's the key to building generational wealth within this industry. Now, for a lot of you guys who are on this call, whether it's Instagram, Facebook, Zoom, have this going on throughout, and we share it after, the common buying concerns of what I am seeing right now. And in many instances, some clients are saying, they just don't know what to look for, right? Or I just had a client who closed on Monday. She was actually a past student from one of my seminars in January. She was looking in North Jersey. Eventually, she was looking for a while, actually, even before she met me at one of my seminars. We shifted our focus from North Jersey all the way down to South Jersey, West Deptford, which is deep South Jersey. And we found the perfect home the first time, and the house fell through due to home conditions. We found another home, checked all the boxes. It was actually more affordable, again, going to South Jersey, and she was able to look for it. But again, the power of the connections, right? They were working with a realtor up north who was one of my partners. Unfortunately, doesn't really travel that further down south. We connected them with another agent that I work with down south, found what they're looking for, understood that looking online is not going to always yield you, especially within this market. By the time you see something, it may or may not be available. Utilizing a trusted professional that we have, awesome partners in specific demographic areas too, which is how I run my book of business, just truly gives you the ability to realize what you're looking for, how to look for. I had a consultation phone call earlier today with a client, and she had mentioned that she prefers to stay around that Bergen County area, but I already knew, based on kind of what the client was looking for, I, as a professional, needed to kind of nudge her a little bit further down south because of the price point, because of understanding what's out there, because I wanted to make sure that her options aren't limited. Okay. And that's what our job is, not just from the mortgage professional and our real estate partner side, is to show you your options and get that buying concerns out. Okay. Because there's never a right or wrong time to buy a home when we're going through these options. Okay. Now, the financial stress, a lot of people buying concerns just consistently because of the financial stress. Many clients just don't understand what are the best mortgage programs. In many instances, a lot of clients are just teetering once again to the internet or teetering once again to their friend who bought 2 years ago. The market is significantly different than it was 2 years ago. The market is significantly different than it was 2 months ago. Okay. It is consistently evolving and consistently shifting. And the professionals that are staying successful in this market on behalf of their clients are the ones that are pivoting every step of the way. Okay. Pivoting when it comes to shifts in the LLPAs, like I showed you guys with the loan level price adjustments. Pivoting when it comes to if you have a situation where a house under appraises. It is just so important. What up, Pete? So important for you guys to be able to work with that professional who's going to truly remove that financial stress. Okay. Now, it's obviously stressful no matter what it is that we're getting into, but our job is to make sure that you're going to find the perfect program for you. Okay. For you as a professional, that is our options to make sure that we understand that and we truly vouch for you. Okay. I can confidently tell you guys the offers that got accepted today from my clients. We literally went to war. Okay. Talking to the agents. One of them luckily knew me from a different event that I used to be a part of that they actually came, that we hosted, knew me, saw my picture, saw the branding, we connected. They had higher offers, higher down payment requirements, but the confidence of knowing the deal is going to get done, I more than know that that gave us a little bit of a boost of what we needed to, and gave that little bit of an extra call when I can call them and let them know, hey, dude, we can confidently get this done. Okay. So taking away that cluelessness of where to begin is my next point, right? Reverting to the internet, again, it's just so much contradicting information, guys. When I try to see, a lot of data points always comes out in the morning, 8:30 in the morning, right? Unemployment numbers, CPI numbers, PPI numbers, wholesale inflation. We'll see the consumer price index will come out soon. We're going to see, obviously, we're going to see the CPE. So a lot of different data points come out, and it really is difficult to articulate and understand. Forget about mortgages. And remember, I own a mortgage licensing school with the Department of Banking. So I literally teach this stuff day in, day out, eat, sleep, breathe mortgages from the second I wake up to the second I sleep. And I still get confused, okay, when I'm reading certain things. When I need to look at guidelines, when a client is buying an investment property and they're buying a two-family and they want to go conventional and it's owner-occupied, and I'm like, I think it's 15%. I'm like, let me double check. And I always know where to go to the right resources place. And I'd be like, yes, if it's a two-family conventional and you're going to live in the property, you can put 15% down. If you don't have an FHA loan, don't have to be a first-time home buyer. If you don't have an FHA loan and you're going to live in the property, you could put it as low as 3.5% down. Okay. So I think it's setting those proper expectations for the clients is truly what it is, and finding those professionals that are consistent, that's going to guide you to the right direction. Okay. So again, the markets that we're in, what I'm expecting, we're going to start seeing teetering, right, into October, November. September is right around the corner. So October and November, we're tallying up home sales. We're expecting them to come up again in that 500, 600,000 number of homes that's out there. So again, listings are flying off the market. And I could talk specifically within New Jersey because I do lend throughout the entire nation, in Pennsylvania, in Florida, Michigan, and you do see different markets, but we're talking here within New Jersey. The market is competitive, and it's been like this, guys, for quite some time. It's been like this for the last 3-4 years. So it is important for us to get ahead of the competition, especially when we're brand new to this home buying process, okay? And the first key steps, guys, that are going to allow us to go from there is this statistic: 78% of people want to own their home, but still almost 70% of people still rent their home, okay? Which is a pretty crazy stat if you think about it, right? Now, working with us and some of the options that we do. So most of you guys are on this call through all the different platforms that we're on here, right? Because you want to buy a house, whether it's your first, whether it's your investment property, whether it's a colleague, whoever the case may be, you know that you want to place an offer on a home and you want to plunge right into the market. So you found something perfect for you guys. House is listed for 500. You put in an offer, you're confident you're going to get it, and then you don't. And you're like, hold up, what am I doing wrong? And it could be literally a laundry list of different things that may or may not go right on file, okay? One of my trusted partners, one of the offers that got accepted was actually a backup offer. And so I'll talk later about that, because that's actually where a lot of our backup offers now are getting accepted, because these lenders are doing these pre-approvals and they're not fully vetting their clients, and then the deal's falling through, or wrong expectations are being made where they're telling a client to waive the appraisal, they don't have the funds, and then it's falling short. We'll talk about that in a few. But again, comparing the buyer's market to the seller's market, guys, we're raw deep in the seller's market. We've been like this for quite some time. But again, it doesn't necessarily mean that there's not the right house for you, and you don't always have to go $40,000, $50,000 higher than the purchase price. You have to go generally at a minimum of the purchase price. For the most part, yes, depending how long the house has been on the market, how motivated the seller is. One of our offers got accepted, a two-family in Patterson. The guy's been trying to sell it for 1.5 years. We got the offer accepted, $15K under ask. So is there different homes out there that are going a little bit higher, a little bit lower? Yes, of course, absolutely. But if a house has been listed very recently and you're seeing a line out the door, you're not getting it at ask. And to be completely honest, you're probably not getting it $15,000, $20,000 more. And that's the conversation that is just so crucial for a client, for a realtor, for whoever it is, to have that conversation with that mortgage professional, setting the proper expectation. Okay. Because if that expectation is not set correctly with that client, where if you're going 30, 40K over and your monthly payment's going to be $100 more, which is amortized over this amount, the numbers must add sense. And our job is to make sure that the numbers are explained to you in the simplest terms, right? And taking it from there. So now when we go there, the one thing I want you guys always to remember is the crucial part is we want to make sure our offer stays as clean as possible. It has to stay clean with very, very limited contingencies if you can, okay? And there's 3 common contingencies, and I've shot numerous videos on these before, but 3 common contingencies I want everyone to think about, which is the appraisal contingency, the inspection contingency, and then you're going to have the financing contingency, okay? Appraisal, inspection, financing. Financing contingency, rarely will you see it waived. There's always an attorney during attorney review is going to put a financing contingency, which basically means that you're protected, that if for any instances your financing is not able to go through, the deal dies, right? And you would receive back generally your earnest money deposit. Again, guys, don't hold me to this if you've ever been a victim of that, but for the most part, if you have a financing contingency in place and you're unable to receive financing, whether it's assets, income, the appraisal came in too high and you didn't waive it, or came in too low and you didn't waive it, you generally have the ability to be able to exit the contract. Now, the appraisal contingency and the inspection contingency, I'm going to talk about very, very deeply, throughout the call, but we'll continue. But again, if you have the ability to present an offer as clean as possible with no contingents of sales is another one. So this is the tricky one that we're running into right now, where some clients have a home that they want to sell, which again introduces an extra party, right? Introduces an extra buyer, introduces an extra seller to the table. And that unfortunately is looked at as a deterring factor when you're purchasing a home, right? And really mainly because the offer is coming in with that extra constraint, right? It's coming in with that extra home, has to be sold in order to purchase, which is just taking things off of the buyer's plate, obviously, right? And adding in another loophole in place as well. Okay. So when a seller is receiving a ton of different offers, guys, it's just so important for you to be able to do your best to present as clean as an offer and working with your realtor and lender to do so, right? Just like I say here. So I tell my clients traditional contingencies are like a deck of cards. You hold it to your chest for protection. Your loan, your appraisal, and your inspection are the main ones. As you lay them on the table and you give them up, this makes your offer more appealing to a seller because you have less opportunity to back out the contract. The name of the game, right? How much skin in the game do you have? And when you're showing to the seller that you're hyper motivated and you want the house. When I bought my house down in Ocean County, I knew what we had to do. I waived the financing contingency, waived the appraisal, waived the inspection. We went 65K over. We were able to close in 8 days and we were ready to rock. And we had another offer that came $90,000 over, but didn't have similar terms. Okay. And we were able to win the bid. So I think it's just truly the combination of the offers are really the important items of what you as a consumer need to be doing in an effort to qualify. Okay. So now the next topic point that I want to go over is when you're going to a home simultaneously, I have literally seen deals die when you're asking for personal property. And personal property can come down to your chandelier, can come down to the jacuzzi, can come down to even as minuscule as the dishwasher, the fridge, or very commonly the washer and dryer. So when you are placing an offer, try your best to limit the personal property items that you're looking to acquire. Okay. If they leave it, they leave it. Great. That client I was telling you guys who closed on Monday, I literally called her after the walkthrough. I was like, hey, how did everything go? She goes, hey, it was great. You know, the sellers actually left everything clean, and they actually left us a bunch of stuff too, which is great. That actually happened to us too. When we bought the house and we went in a little high, luckily, thank God, the house appraised actually more than what we offered. Plus that, we got a lot of stuff too. They left us the hot tub, which actually ended up breaking, which kind of sucks. I had to buy a new one. But they left us that, left some lawn furniture, you know, some inside furniture, and I felt like we were able to kind of recoup, quote unquote, some of the. We let them stay in the property for about an extra week for free, and so nice people. But I think it comes down to that, right? It's important for us to remain focused on the goal, which is buying the house. Many times we allow, unfortunately, without really even realizing it, that ego to get the best of us. And then we just truly end up in a position where we're just buying a house, but we're just truly buying a house and trying to pull as much as we can to get that deal, right? Everyone's out there to get that deal. Now, when we're going over price range, because let's be honest, pricing happens to be one of the driving forces of your offer. It's important for you when you're going to offer above asking that you understand the type of market that you're looking into. So a seller's market is just not a place for you to make a low offer, especially if the house is new. Nobody's going to bite. You will have to make your offer strong enough to beat out multiple bids. In order to get the seller's attention, this is actually one that we've been doing. You offer to pay the seller's closing costs, and you could throw in an extra $1,000 to $2,000 to stand out. That can literally save the deal from you having to go on the other side and throw an extra $5,000, $10,000 on your purchase price. Now, what does it cost? Making an offer above asking, again, in the long run spread, if you're getting a 30-year mortgage, 360 months, offering above asking, right? It does not end up costing much in the long run. And guys, I've had crazy situations with FHA loans. One appraises under, the next one doesn't, but then the next one has flags. I've had situations where the house under appraises. They didn't count the garage. If you guys remember from my call, like two times ago, when we were going over the one house where he didn't count the garage in North Cape May, we had to fight and dispute it and get it, and he added the value. So many different things that come into play, but truly getting that understanding of what does it cost when you're placing that offer, right? And the extra value of what you're placing, that is going to allow you the ability, that's going to change significantly if your offer goes above asking, okay? And then getting considered. So you do want to, again, keep your offer aligned to the value. And this is the thing I always tell people. You know, if a house is listed for, I mean, I see some of this stuff on Instagram, it's freaking wild. But if a house is listed for 500, depending on the comps and depending on what's out there, you know, you don't want to sit there and go and offer $700,000. They're not going to take you seriously, even if you have the means to get it, because it's just truly unrealistic, unless you're paying with cash. I'm talking about going straight financing. When you're running the comps and the comparables with the listing agent and you're going over the various options, finding the right home and securing the home with a combination of, we're going to go, and I'm going to show a checklist towards the end of this call of what are the checklists that you as a consumer should be having when you're placing an offer within the houses to get considered, okay? So another added data point that I want us all to remember is, remember when I said showing extra skin in the game? So when you're placing that offer to get that offer accepted, you want to put that strong down payment, that strong deposit up front. So if you're going in and you're doing a 20% down payment, I always sometimes recommend our clients to put the entire 20% upfront as an EMD, or put 10% down upfront as an EMD. Or if you're putting a 5% down payment conventional, try your best to put the entire. It just truly stands out. And it also shows to the listing agent, once again, that you're willing to put more skin in the game, as I say it, right, in an effort to be able to do it. Many times on average, you're doing 1 to 3% for the purchase price. If you're willing to take that and put it, as I always recommend all of our clients to do, you're going to have your offer stand out. Now, Is there strategic avenues, ways from a legal perspective for you to get out of the contract? Yes, all depending on how the offer was presented, from an appraisal perspective, from an inspection perspectives, and things like that. Okay. But it is important for you guys to be able to type that up, and that offer will be put together and you'll be able to sign the contract and take it from there. Waiving the appraisal contingency. This is, I probably have this conversation 200 times a day. An appraisal contingency, once again, can be given up. It does pose what I call the quote unquote most risk. You don't have the cash, but once again, the importance of utilizing your real estate professional, and that real estate professional alongside the lender is going to look at the comps. They're going to make sure that you're protected. They're going to make sure that the homes that are going on the market fit very similar specifications to what you do, and that also they've been sold is a big one, right? And that the house itself, that are surrounding areas, have gained interest, and the property values have simultaneously went up as well, okay? So an offer indicating your intention to bring money to the table if the house doesn't appraise is going to set your offer apart. Well, one of the offers that we got accepted today, like I said, we actually came in 5% down, conventional, but we came in pretty aggressive on the sale price. The listing agent straight up told me that, hey, we have offers with 20% down, very similar price ranges. We started shooting shit. And it's just so important that the proper expectation is explained and set to your clients, because that is the driving force for a client to get their offers. And not just in this market, for quite some time, right? A lot of the tactics that I've been doing, guys, it's been following the same things for the last 3, 4, 5 years. Okay. Do you fine tune it? Yes. Do you pivot, like I mentioned earlier? 100% into what's happening within the market conditions and stuff. But a lot of it roots down to the same expectations, and education being set in force is going to allow you the ability to be successful. So, like I said, if you have the ability not just to put an upfront higher deposit, but put a larger down payment. So depending on what type of loan you close, right? Or what type of loan you choose. Whether it's an FHA loan, conventional loan, VA loan, USDA loan. I've done VA loans where clients put money down. Offering to pay more down, again, is a sign of good faith. That was one of the questions of why the listing agent was a little hesitant to take my one buyer's offer earlier today. We're only putting 5% down. He had other offers at 20. And I simply went over and said, client have the funds, but frankly, I'd rather them have the funds there in case there's an appraisal shortage, an appraisal gap, rather than if there's any situations where they come 20, we have to go back and forth, we negotiate, and then the seller has to cut their price. No seller wants that, right? They want to be able to reap what they can and essentially have a guarantee of what somebody is purchasing. Okay, see if we have questions. A lot of people popping in. We'll take it from there. So moving on. So then what we're also seeing again is that trigger with the down payment. A lot of clients, you want to be able to, you say you have the money that you're doing it, you want to be able to present POF, right? You want to be able to have those proof of funds clearly showing to the agent that, yes, I have the ability to place that money down. I have the ability simultaneously. I'm serious about this purchase and I want to be able to make it work. Okay. So those are the expectations that you want to be able to set. Now, there's other avenues that is also called, if you're not looking to waive the appraisal entirely, there's something called an escalation clause. I'm not necessarily the biggest fans of them, but an escalation clause is essentially an offer that outbids another. So for example, house is listed for 500, you really want it, you offer 530, but then you put a 10K cap, or you do a 10K escalation to 540. Which means that if anybody else comes anywhere between 530 to 540, you're able to match and beat them, right? Whether it's like someone comes in at 545 and you come in at 546. Okay, so those are escalation clauses. Again, keep in mind that even if you provide an escalation clause, it may be in the seller's interest to counter you back. And many times they do. A counter offer is essentially them accepting that escalation and saying, hey, dude, no, we would rather just take your 540. So it is kind of like, you guys remember when I was showing earlier about keeping some of those cards to yourself, right? If any of us play cards. So keeping some of those cards to yourself, again, in an effort to not have to show everything that's in your playbook, okay? So flexible closing and offering free stay. So flexible closing is crucial. And you as the client, of course, including your real estate professionals and stuff like that, you want to be able to also understand what is the seller simultaneously, what is their position, right? Are they, what is the seller's position? Are they simultaneously looking to vacate the home? Are they not looking to vacate the home? Do they need time to stay, which is what I have over here, right? When you're offering to a seller, you're gonna buy the house simultaneously, but they need to look for a home. You, as a consumer and at an avenue, need to be flexible to allow them the ability to stay in the home and at the same time let them vacate. Okay, so important for you guys to remember that, because those are small little added tactics that you can. It is called a UNO. It's called a use and occupancy. Always want to double check with your attorney. Many instances, some attorneys are a little bit sticklers when it comes to that. So we want to make sure that we're having the right proper conversations where there's hold harmless agreements being signed in advance and stuff like that. Okay, so a lot of different avenues for us to explore, but the flexibility for us to take those items in place are just so crucial for us to remember. So that's that when it comes to the different tactics and strategies in there. Anybody have any questions based on those topics? And then this is going to be kind of a little bit of a refresh. Anybody have any questions in regards to what I had just discussed? Boom. Awesome. So we're good. So again, kind of doing a little bit of a recap. One of the things that I always like to tell our clients when it comes to the client engagement, I'm a very big communications type. So I want to make sure our clients are aware. So as I always say, right, 60% of clients who we stay in consistent communication with, right, we want to make sure that they are staying engaged, they are staying educated, they know the options that are out there, and they know what is being simultaneously explained to them, right? So the proper expectations are made. Okay. So I always say group text, with my clients. And as I always say, eyes open to eyes shut, Monday to Monday is when we're looking to set the proper expectations. Now, this is a conversation that I love to tell our clients, right? Forget about the interest rate. Interest rates are 7, interest rates are 8, interest rates are 6, 2. The one common thing I have always actually said is most of us here has financed a car. And I guarantee if I asked anybody, hey, do you remember what your monthly payment is on your vehicle? Almost everybody is going to be like, yeah, I remember what my monthly payment is on my vehicle. I was paying $550. And then if I ask them, okay, well, can you tell me exactly what your interest rate was on that car? Many times they're going to be like, you know what? I need to pull up my, I need to grab my contract or wherever the case may be. Exact same thing when I say when it comes to a home. Don't get too wrapped up about that interest rate. Oh, 7.25 sounds better than 7.5. So I'm going to run to that. Doesn't necessarily always work because that 7.25 comes at a cost. And it might cost you $3,000, but you're only saving $50. So why run to that? Doesn't necessarily make sense. So those are things that I always like to tell my clients. You want to make sure that you have the proper expectations set in place. And the thing I always tell them, what we want you to be most mindful for, so there is no payment shock, right? We want to keep an eye on your monthly mortgage payment and your cash to close. Monthly mortgage payment and your cash to close. Those are the two most crucial items that people need to be keeping in mind for. Your monthly mortgage payment and your out-of-pocket cash to close are two of the driving forces that clients must keep in mind, okay? Because if I can tell you, hey, dude, your monthly payment is $3,500 and your total cash to close is $25,000. Got it? Yeah, boom, done. But if I tell you, hey, you know what, at a 7.25, you're at 70, you're at 26,000 and your monthly payment is 3,200, it's very confusing. Now, don't get me wrong, I very, very much enjoy doing a total cost analysis and explaining things to the clients and stuff. But I always like to do it concentrating on those two main points. What is your monthly payment? What is your cash to close? Okay. And if you want the lowest monthly payment, your cash to close is going to go higher, because the lowest monthly payment means you're going to get the lowest interest rate, and the lowest interest rate is going to get a cost of acquisition, which is going to make your cash to close go higher. Why don't we find that mesh right in between, depending on your circumstances, find that mesh right in between for that monthly payment, for that cash to close, and make it happen. Now, the next items, again, when we're strategizing our offers, as a recap, again, I want you guys to remember when we're placing an offer and the market is, again, shifting to multiple offers, it's been like this for quite some time. What I want many of us to remember are the topic points that we discussed. So when you're making an offer, of course, many instances, the thing that's going to take the top precedent is going to be run. Can you go higher on your monthly payment? We can all agree to that. Now, your loan type, as I mentioned earlier, sellers are more prone, for many instances, to take a conventional loan over an FHA loan. And it's mainly, the main factor is, aside from credit, the main factor is because an appraisal on an FHA loan is very, very much more stringent than on a conventional. So if the property is in good condition, who cares what the loan type is? You know, I'm going to be biased in that point because I do get pissed. So many times we go to our clients, and when we're going in FHA, FHA offer goes in, and we say that we will cover any flags that comes to the appraisal, which now truly creates that evil level playing field, right, with our clients. Okay. So it's a small little tactic that I want you guys to remember that truly gives us the ability at the same time to stand out. I'm always going to be biased, and I'm going to say going with a direct mortgage lender who has complete and total control over a broker who's got to go through me, or over a broker who's got to go through a lender, right, in order to get there. Now, don't get me wrong. Brokers are great. I have no problems against it. Great business models and stuff like that. But again, I'm always going to be biased and say the direct lender who's got the underwriter right there, or who has utmost control. Now, as a lender, I also have control over margins, and I have control over my interest rates. And I know that I want to give my clients the best possible interest rates, and we do. And we set proper expectations, and our reputations constantly go there, and they say for themselves. So now when we go over timelines, closing quicker over prolonged, again, the importance of being able to close quicker, depending on the circumstance. You want to be able to understand what is the seller's motivation. What is the seller looking for in an effort to get their offer accepted? Okay, so those of us who are on Zoom, take a look at this. You're going to see here, again, when we're talking about those who are looking to get their offers accepted, but the house is vacant. That seller wants to close tomorrow. So therefore, we need to be able to go in and do our typical 7-10 day closings, as I do for many of our clients, right? We want to be able to close quicker. I'm prepping the file, putting it together, done, handing it over to my processor. She's putting it together. She's preparing it, submitting it. My underwriter's grabbing it, clearing the file, pushing it back. Those are going to be the competitive advantages to get the job done. Very simple. Contingencies, we went over already. So we went over the financing contingency, we went over the appraisal contingency, and we went over the inspection contingency. Okay. So again, understanding the differences between those and what are the common variables that is going to truly allow you to get your offer accepted. Okay. Now, when we go over appraisals and inspections, so that's another important part. We went over inspections in many instances right now, the clients will not waive them entirely. They will limit them to environmental, structural, and foundation. Okay. Which means that any small nicks and knacks, chip paint, window here and there, you got to kind of take it how it is. But if there's a crack in the foundation, you as a consumer have the ability to negotiate. Seller fix it or amount. If there's roofing, you know, in many instances, that'll kind of fall into that structural. If there's problems with the heater, the water heater, or the boiler, again, that falls under mechanical. So keeping those items in place, guys, is super important. And then again, deposit and down payment. We went over the higher upfront deposit, right? And if you can, higher upfront down payment is truly what's going to allow you the ability to truly stand out, right? Now, 10 tap again, guys, this is something you could screenshot if you're on your phone. The top 10 tactics to win, top 15 tactics to win, right? The first thing is an escalation clause, lease back in UNO, appraisal gap and waiver, higher upfront deposit, a reputable local realtor and lender, covering the client's moving expenses and transfer taxes, understanding closing terms and understanding the seller. First to view, first to offer. This is an important point. I want to stop here. So that saying where you go to a car dealership, you see the house and you don't want to, or you see the car and you don't want to offer it, but then the person who saw it yesterday and said they want to think about it comes back to the dealership and buys it. Guys, same exact situation here. Okay. I always tell that to my clients. So it's so important that if you do find a house that you really like, you are setting that proper expectation in place, right? If you see a house you like it, now I'm not saying rush into it, but surely make sure that you're setting that proper expectation, right? Where if you like something and it fits the specs, you should pull the trigger faster than normal if you really want to have an opportunity to get it accepted. Inspection contingency, guys, we just went over. Financing contingency, we covered. Down payment sourceable, super important, right? Proof of funds, right? Proof of funds, essentially, send me a screenshot of your bank statement. I'll send you the account numbers, shoot it over to them to show them that you have the actual money, right? When we bought our house, that was one thing that I did, right? On top of going very high, on top of waiving this, I sent them a screenshot of my personal bank account that showed them that I had the money to cover the appraisal shortage and cover the appraisal and cover the down payment. Clean offer, realistic expectations, obviously, and then being flexible and closing fast. So diving in further again, escalation and lease backs, guys, we went over. So an escalation clause is we're boosting it over. A lease back, we're allowing the property to lease the property back from us. And then we're also going over utilizing a local agent course, most importantly, right? Local agents going to know the homes, they're going to know the markets, they're going to look with a lot of different expectations. Doing more upfront deposit. More upfront deposit, again, it's going to give you guys the ability at the same time to show more skin in the game and earnestly want to buy the house. Utilizing a local lender, again, myself, right, who understands the type of market, the specific area, understands most importantly availability, and where there's a lot of, unfortunately, lenders that are sabotaging deals or pre-approving clients, and the clients should never been pre-approved. It's freaking crazy what I'm seeing out there right now with the number of lenders that are approving clients who should have never been approved from the start. It's wild. Now, if you're making an offer again on a competitive home, and again, he is owner occupied, have to be able to, if you want to get your offer accepted and stand out, be able to show those moving expenses and you being able to will it transfer. You don't have to employ, guys, all these tactics. These are simply all common recommendations that we have for our clients. Understand the seller and be the first to offer. We went over that, right? Not holding on too long, right? When you're placing an offer and you're understanding truly what the seller is looking for. Guys, I was showing you guys about homes under appraising. This is something that's very important. When a house under appraises, one of the things I was talking about earlier was that example in Cape May. If a house under appraises, you have the ability to dispute the appraiser's report and actually revisit the financing, okay? So you can actually dispute the appraiser's report and say, hey, I don't agree with the value that you gave, and I think you missed 1, 2, 3, 4 different properties, right? You get with the listing agents, you get with the buyer's agents, you have them send you some comps and comparables, and then they're able to simultaneously, negotiate and get that changed for you. You can also revisit financing where your lender, if you're putting more than the minimum down payment, can roll that shortage within the loan. You can negotiate with the seller if you haven't waived it to see if you guys meet in the middle, if the seller covers it, whatever's the difference. Or you yourself cover the difference at closing, or you terminate the contract depending on the offer was done. So again, 5 different options that you have. You do run into a situation where a house under appraises that you have the ability to employ, okay? So when we're waiving the inspection contingency, guys, again, once a home goes under contract, the deal is not done. So common that I tell people that. Going to perform the home inspection. So you want to make sure there's 10 different home inspections that could yield 10 different results, right? And sellers are on pins and needles. So you want to make sure that there's truly no major structural, environmental, foundational, mechanical issues that are occurring within the property, because guys, that can unfortunately yield an exuberant amount, right? And then you're going to be instantly regretting the purchase itself. So want to make sure that you're having those proper expectations done. You're going to be waiving the financing. Again, in many instances, you'll get your money's deposit back. Sellers have to start over. It is what it is. That is what's happening now, guys. It is crazy the number of homes that are coming back on the market because of, unfortunately, lenders not doing it correctly. So super important that you keep that in mind to alleviate the seller's concerns. You can choose to waive your financing contingencies in an effort. Like, if I know I pre-approved the client, dude, he's good to go. So clear, flexible, and fast closings. Again, we went over that a few times, right? We want to keep the contracts as clean and easy as possible. We want to make sure that the client is 100% understanding that we can close very quick. They need to make the necessary adjustments simultaneously to move their funds, move their assets, or be very upfront when it comes to getting the documents, all right? And then the last thing, again, guys, this is something that you could screenshot. You do have access to all these stuff again, but you could screenshot this. You're going to see it here. What are the different ways to get your offers accepted? Most common too, again, it's going to be waiving the inspection, waiving the appraisal. Then we take a look at larger upfront deposit. We take a look at structuring the offer above asking, offering the UNO, the use and occupancy, and quick closings, offering to pay the transfer taxes like we discussed, avoiding to ask for personal property, understanding the seller's motivation, very, very important, right? And then working with the right lender when it comes to speed to lead and making sure they're getting the proper response, okay? So, and then the last thing I want to leave you guys with is, as a home buyer and a realtor in a competitive market, you're going to experience these type of situations, guys. I deal with it on a daily basis, right? The amount of stress when it comes to your offer not being rejected, you know, watching other buyers' homes. The tactics that we just discussed is literally from being super mild to as extreme, from covering the transfer taxes, covering various different avenues, putting those proper expectations in place and tactics on those natures. It is truly hunting time when you're out there. You want to make sure that you're working with that trusted professional. So got to stay positive, got to continue to work, you know, on your quote unquote contract skills, right? Utilizing these methods with your realtor, with your lender, making sure that they're all in constant communications to secure your home and get that contract in place, okay? Because it is very important. And, you know, I hate to see clients wasting their times, right? When they're looking at homes and looking at offers and they don't have the ability to get them. And that's it. So I'm going to end a little early today because we kind of blew past this. But again, guys, I want you guys to remember the different market tips that we went over today. You guys have access to all these PowerPoints, okay? For those of you guys who still need the link, please feel free to message me. You guys all have all access to my phone number. So send me a message. We'll be able to put all these informations in front of you once again and truly make sure that we're setting the proper expectations for everybody. I appreciate you guys all jumping on. Any questions that you guys have before we end it? Good. It's answering questions as we go, seeing a lot between Facebook and Instagram. Cool. All right, guys. Well, I appreciate you guys jumping on. Obviously, I'm always available, whatever you guys need. The next class, again, remember, we're now going to be going into the fall. So the next class, guys, is actually going to be starting on Saturdays, okay? So we're going to be doing them from Saturdays from 10 to 11. So make sure that you guys have that in place. 10 to 11 is going to be down to an hour. We're going to go over a lot of different expectations, a lot of different topics and conversations that I want you guys to remember. So have a blessed holiday, or I'll see you guys before that, but enjoy the rest of your summer, and I'll talk to you guys soon.